Hello, everyone. Matt Somberg, partner and co-founder of Gottfried and Somberg Wealth Management. Hope you're doing well. Hope you're enjoying a nice summer so far. We're halfway through the year, so let's take a few minutes to look back at how the first half of the year went and give you some thoughts about the second half. Okay. Stock market's been very positive for the first half of the year. 5 out of the 6 months have been positive. It's never fun when you have a down month, but we've had 5 up and 1 down. The data in terms of the indexes, the S&P's up about 15%. The NASDAQ, sort of tech-driven, up by close to 19%. Markets around the world seem to be doing okay. International is up 5.7, and the bond market pretty flat for the year, but we'll spend a minute or two on some slides related to bonds, and I think there might be some reasons to be optimistic about bonds for the second half of the year. 7th strongest start for the market going back to 1990. In terms of sort of the leaders, last year we spoke about something called the Magnificent Seven, which essentially were 7 companies, as you see here, that really drove the market. Last year, the S&P was up over 26%, but about 16% of that was really driven just by 7 companies. This year, there's sort of a similar theme in terms of concentration coming from a small group of companies. This year, it's really 8 companies. These 8 companies are responsible for about 13% out of the 17% return of the S&P. Some similar names as last year: NVIDIA, Microsoft, Apple, Google, Meta, and Amazon, which were all there last year. But this year have sprinkled in Eli Lilly, which is doing really well with their drugs that lead to weight loss, as well as Broadcom, which is another semiconductor chip maker. So pretty bad financial advisor humor, but chips and weight loss seems to be the themes this year in terms of what's carrying the market. It's interesting where we are right now in terms of where interest rates are. They've remained quite high. That obviously has an impact on a couple of things. The cost to borrow, 30-year mortgage is 7-ish%. And also what short-term government treasuries pay, which in many instances is over 5%, which means many money market funds are also paying around over 5% if they're constructed with short-term treasuries. So higher to borrow, but higher potential interest on savings. And again, just really interesting in this slide here to see how expectations have changed. The blue line is going back to December in terms of what the market or investors thought would happen with interest rates this year. And the anticipation was that we would see 6 interest rate cuts. We're halfway through the year. We've had 0. And so we need some softening of economic data in order to justify some interest rate cuts. It seems like we might be getting there, which I'll talk about in a minute. So right now, if you look at sort of this orangish colored line, the market thinks that maybe we'll see 2 interest rate cuts potentially, 1 in September and then 1 again in December. But that's really going to be driven by what happens with economic data between now and then. In terms of that economic data, I would say that we have a relatively strong economy that over the last month or 2 is showing some slight signs of softening. So for example, this here is the unemployment rate, which has been incredibly low, historically low. And we're starting to see a slight tick up. If you look here in the bottom right-hand corner of that unemployment rate, it's now up over 4.1%. Previously, it was slightly below 4%. So that shows some slight softening there in the labor market. On the inflation side, there's no question that inflation has been incredibly stubborn and painful over the last 3 years. That's sort of been the fly in the ointment of our economy. But we are starting to see some slight softening in inflation as well. You can see over the last couple of months, the inflation rate, CPI, has come down a little bit. So you have a couple of months of some slight changes in unemployment where the unemployment rate is going up. You have a couple of months where we're seeing some disinflation, meaning inflation coming down. Those are 2 of the signs that the Fed would be looking for to show that perhaps they could justify an interest rate cut. So if you're rooting for an interest rate cut, which means borrowing costs are lower, and that's usually bullish for stocks and bonds, we're starting to see some data that shows that might be forthcoming. Speaking of bonds, slide's a little can be complicated, but I'll try to make it simple. So bond prices typically move inversely to what happens with interest rates. So when interest rates go down, it often means that bond prices can potentially go up, and that's a positive for bond prices. And with that in mind, what this slide tries to show is what could potentially happen with bond math if we were to see some changes in interest rates. So for example, I'm just going to focus on the short term and what in theory might happen in the next couple of months. So where it says yield change over here, this is basically what would happen. This is a percentage reduction in interest rates. So I'm going to come over here where it says 1/2 of 1%. And then I'm going to come over here where it says fixed income assets. These are different types of bonds. So US Ag is just the entire bond market. And then next to that would be, for example, an element of the municipal bond market, and then multi-sector bonds. But just to maybe focus in on one thing, what a slide like this suggests is that if we have a 1/2 of a 1% reduction in interest rates, that the US Ag, which is just the entire bond market, would see appreciation of approximately 7%. If we had a 1% reduction in interest rates, the bond aggregate would go up by 10%. And I'm not suggesting, we would not suggest that that's happening, but it shows that right now bond prices are so low and yields are so elevated that if we had a reduction in interest rates, it would be a very bullish sign for the bond market. So it is possible in the future we see the over 5% returns in money market funds start to trickle down. And if the returns in money market funds are starting to trickle down, it's because interest rates have been reduced. And if interest rates have been reduced, that can be very bullish for bond prices going forward. And look, bonds have basically done nothing for 2 years other than pay coupons. So markets are very cyclical, and a reduction in interest rates would just be the catalyst to start moving the bond market in a better direction. In terms of the economy overall, corporate earnings remain strong. This is an exciting time to be an investor with regards to the innovation that's happening with artificial intelligence, the innovation that's happening in medicine and in healthcare. There's lots of disruption and innovation that's taking place. And so stock prices are supposed to follow their earnings, corporate earnings. And what we see here in terms of corporate earning expectations for 2024, and then again for 2025, they continue to be bullish and solid. So cautiously optimistic to see stock prices continue to go up if in fact they follow earnings. In the next 2 calendar years, earnings growth is expected to exceed over 10%. On a sector by sector standpoint, our economy is comprised of 11 sectors. It's not unusual to see a few sectors down and a few sectors up. What's unusual in 2024 is that the very significant gains that we see on the technology side and on the communication side, just really how they stand out compared to the other sectors. But there really hasn't been a sector that's lagged. Maybe the real estate sector is down a little bit, and that's not residential real estate prices. That's the stock prices of companies that are in the real estate business here. So reasonably good diversification across the board there in terms of where the returns have come from, although communication and technology clearly is way ahead of the game, driven by primarily innovation in artificial intelligence. If you've, for some reason, had more important things to do in the last 6 months instead of making it to this slide in our video, then you'll see this for the first time. This is a presidential election year, and we've spent some time taking a look at history in terms of how markets behave and perform depending upon who the winner of a presidential election is. And so if you're seeing this for the first time, the conclusion here is that markets go up and down irrespective of the party that wins in a presidential election year. It's been both positive and negative when a Republican has won. It's been both positive and negative when a Democrat has won. There's not a consistent pattern there. If there's any takeaway, it's that markets have been positive in 20 out of 24 presidential elections in the last 100 years. It's over 80%, so that's quite good. The S&P 500 during presidential election years tends to average, or has averaged, 12%, which is higher than what the returns are in the S&P 500 when we look at non-presidential election years. So that's, potentially bullish as well. But look, we're halfway through the year and the market's already up double digits. So certainly there's 6 months to go, but there's plenty of reason to believe that we're going to stack another positive return or potentially stack another positive return. That would be the case if the market had ended right now, 6 months through the year. So we'll see what happens in the second half, but certainly a pretty good head start so far. And in terms of parties and sort of, does it make sense to try to time a market depending upon the party of the president? This slide here is pretty powerful. If you were invested in the S&P 500 going back to 1950 and only invested when we had a Republican president, you can see where your returns would be today if you sold every time a Democrat won and invested every time a Republican won. The blue line, which is really not much better, is if you sold every time a Republican won and stayed invested when a Democrat won. The black line is incredibly powerful. The average total return under a 4-year presidential cycle for both Democrat and Republican is 46%. So the message there is historically makes a lot of sense to just stay invested, irrespective of who the winner is of a presidential election. So just some food for thought and some things to think about relative to the first half. Some positive signs in our economy. Some data recently showing that we might be closer to our first interest rate cut, and some data there showing that when interest rates go down, that might get potentially might get the bond market moving in a better direction. So hope you're having a great summer. If there's anything that we can do for you, please reach out to the advisor at the firm that you communicate with the most, and we'll be back probably in a month or so to wrap up the summer, look at the fall, and take things from there. So thanks very much.